Most people only think about an emergency fund after the emergency has already happened. The car breaks down, a medical bill arrives, a job suddenly ends, and in those moments, they reach for a credit card, a personal loan, or money borrowed from family. An emergency fund is the quiet financial cushion that decides whether a hard moment becomes a small problem or a long-term debt trap. It is the foundation of every healthy financial life. An emergency fund is simply a pool of money set aside for unexpected expenses. It is not for vacations. It is not for new gadgets. It is not for sales that feel urgent. It is for the situations life surprises you with: medical issues, job loss, car repairs, urgent travel, or sudden home repairs. Its only job is to protect you when the unexpected arrives without warning. This fund matters because life is unpredictable, but most household budgets are not. Without a cushion, even one bad week can push a person into high-interest debt. With a cushion, the same week becomes uncomfortable but manageable. An emergency fund does not solve problems. It absorbs shocks, and the more shocks it can absorb, the less likely you are to make rushed, expensive financial decisions in stressful moments. A common starting goal is 3 to 6 months of essential expenses. Essential means rent or mortgage, food, utilities, transport, insurance, and minimum debt payments. It does not mean your full lifestyle. If your essential expenses are $2,000 a month, a beginner goal might be $6,000. A stronger goal would be $12,000. The size depends on how stable your income is and how many people depend on you. Let us look at a simple example. Imagine someone earning a modest salary who suddenly loses their job. With no emergency fund, every week becomes a panic about rent, groceries, and bills. With even 1 month of expenses saved, that panic shrinks. With 3 to 6 months, the person has time to job hunt calmly, negotiate properly, and avoid taking the first offer just to survive financially. A common mistake is mixing your emergency fund with your everyday checking account. When the money sits next to your daily spending, it slowly disappears. You tap into it for small wants and convince yourself you will replace it later. But by the time a real emergency happens, the fund is gone. Emergency money needs its own home, separate from the money you spend without thinking. There is also a hidden risk when there is no fund at all. Without savings, every emergency becomes a borrowing event. Credit cards, payday loans, and personal loans charge high interest, and the cost stretches over months or years. The original emergency might be $500, but the total cost can balloon. People do not get trapped in debt because they are reckless. They get trapped because they had no buffer. A useful way to picture an emergency fund is as a seatbelt. You do not wear a seatbelt because you expect to crash. You wear it because crashes are sudden and unpredictable. Most days it does nothing. But on one specific day, it changes everything. An emergency fund is the same. Quiet, often boring, mostly unused, but on the one day you really need it, it protects everything you have built. A second key idea is where you keep the fund. It should be safe, separate, and easy to reach within a few days. A normal high-interest savings account is a common choice. The fund is not meant to grow aggressively. It is meant to be reliable. Putting it into volatile investments may earn more in good times, but it can also lose value at the exact moment you need it most. A practical example helps. Imagine you have saved $6,000 for emergencies. Option 1 is keeping it in a separate savings account. Option 2 is investing it in the stock market because you want it to grow. The trouble is that markets can drop sharply. If you lose your job during a downturn, both your income and your emergency money may shrink at the same time. That defeats the purpose. Beginners often misunderstand the order of priorities. They want to invest first and save emergencies later, because investing sounds more exciting. But without a cushion, a single bad event can force you to sell investments at a bad time. The emergency fund actually protects your other long-term wealth. It is the boring layer that lets the exciting layers above it keep growing without being disturbed. There is also an emotional side. Having even a small emergency fund changes how you feel about money. You sleep better. You make calmer decisions at work. You are less afraid of small surprises. People often describe their first 3,000 or 5,000 saved as life-changing, not because the amount is huge, but because the constant background anxiety finally drops to a manageable level. A simple practical rule helps you start. Pick a small first target, like $1,000, and treat it as untouchable. Once you hit that, raise the target to 1 month of essential expenses. Then aim for 3 months. Then 6. Breaking the goal into stages makes it psychologically possible. Most people fail not because saving is impossible, but because the original target felt too far away. There are a few things to avoid. Do not redefine what counts as an emergency just because you want to spend the money. A new phone is not an emergency. A nice vacation deal is not an emergency. Do not invest your emergency fund hoping for better returns at the cost of safety. And do not skip rebuilding the fund after using it. The protection only works if it is replenished. A better habit is automation. Set up an automatic transfer that moves a small amount to a separate savings account on every payday, before you see it in your checking. Even a modest weekly amount adds up over months. Most people overestimate what they can save in a month and underestimate what consistent automation does over a year. Quiet systems beat loud effort. Over the long term, an emergency fund changes your entire relationship with money. With a cushion in place, you can negotiate harder at work because you are not afraid of losing the job. You can avoid bad loans because you do not need quick cash. You can take measured risks like switching careers or starting something new. Financial confidence often begins not with income, but with this single quiet cushion. So here is the short version. An emergency fund is a separate pool of money for true emergencies, not lifestyle wants. It typically covers 3 to 6 months of essential expenses. It should sit in a safe, accessible account, not risky investments. It is built slowly through small, automated contributions. Its purpose is not growth. Its purpose is protection. And that protection is what makes every other financial step possible. If you want to be financially strong, the emergency fund is the very first habit to build. Start small if you must. Even $100 in a separate account is better than zero. Automate the next contribution. Protect the fund from yourself. Refill it after every use. None of this requires advanced finance. It just requires a quiet decision to never be one bad week away from financial disaster again.